All right. Ready to dive into the Indian stock market.
Let's do it.
Today, we're taking a page from Shashank. He's a real pro when it comes to this stuff.
Yeah, he's got a great approach.
And we're going to kind of break down his strategies. So, we always say this isn't about, like, telling you what to do with your money. It's more about, arming you with the knowledge so you can make those decisions yourself.
Yeah, exactly. Think of it as becoming a smarter investor,
Exactly. Like leveling up your investing game.
There you go.
So one of the things that really struck me about Shawshank's philosophy is this whole idea of long-term, like really playing the long game, not just these quick little wins.
Yeah, he's all about those long-term gains. Like he talks about building a portfolio that's, meant to grow over a decade or more.
Wow. Okay. So real patience, real commitment to this.
Absolutely.
And that's where high conviction investing comes in, right?
So
it's about like really believing in the companies you're putting your money behind.
yeah, it's about finding those companies that you're like, I have a really good feeling about this. I'm willing to bet on their future.
I like that.
So the first company we're going to look at is a perfect example of that. It's K-Pit. They're really riding the wave of the whole automotive tech boom, especially with electric vehicles.
Okay, so K-Pit, automotive tech, EVs, huge right now. But what makes them stand out? I mean, there's a lot of companies trying to kind of get into that space.
Right, but K-Pit, they specialize in the software, particularly for EVs. And that's a market that's like exploding right now.
So they're not just like making electric cars, they're the brains behind them, kind of?
Yeah, you could say that. They're developing the tech that makes these cars go.
Okay, and their numbers seem to be backing that up, right? I mean, we saw that, like 34% top-line growth, and their profits jumped something like 61% in just a few years.
Yeah, 3 years, that's it.
That's wild. What's driving those numbers? Like, what are they doing right?
Well, for starters, they're laser focused on this niche. And they're not afraid to be on the cutting edge,
Okay, give me an example.
They're like leading the charge on sodium-ion battery software.
Sodium ion. Okay, so that's even newer than the lithium-ion batteries we hear so much about.
Exactly. They're already thinking about what's next, staying ahead of the game.
Okay, but with that kind of growth, with that kind of potential, I'm guessing their stock price isn't exactly cheap.
Right. They've got a pretty high PE ratio, sitting at 72.
Okay, for those of us who don't speak finance, break that down. What does that 72 actually mean?
So the PE ratio, it's basically like a price tag. It tells you how much investors are willing to pay for every dollar of a company's earnings. So a high PE, like K-Pit 72, means investors are really, really optimistic about their future.
They're like, we believe in you, K-Pit.
Exactly. They're betting on them to keep growing, keep innovating.
But that's got to be a lot of pressure, right?
Oh, absolutely. Yeah. High expectations can be a double-edged sword. If they don't meet those expectations, even by a little bit, the market can kind of freak out.
So it's almost like the higher they climb, the further they can fall.
You got it. It's a risk to keep in mind.
Okay, so we've got this high growth potential, but also this risk factor because of their valuation. Anything else we need to kind of factor in here?
Well, there's always the geographical element.
Yeah.
K-Pit gets about 60% of their revenue from the U.S. and Europe.
Okay. And with everything going on right now, recessions looming, that's a consideration, right?
Exactly. But this is where Shashank's long-term view really comes into play. He's not worried about those short-term blips.
So he's not hitting the panic button over a potential recession?
Nope. He's looking at the bigger picture.
Okay.
And K-Pit has a strong order book. They're constantly investing in R&D. They're not just resting on their laurels.
So they're not just riding the current wave. They're building a bigger, better surfboard for the next one.
There you go. And Shashank actually has a strategy for navigating these market peaks. Dollar cost averaging?
Dollar cost averaging. Now, I've heard that term before, but remind me what it is again.
Sure. It's basically just spreading out your investments over time. So instead of putting all your money in at once, you invest a little bit at a time, maybe every month, maybe every quarter.
Okay, so you're not putting all your eggs in one basket, and you're potentially buying more shares when the price dips a little bit.
Exactly. It's a more measured approach, less risky, especially in volatile markets.
Okay, so we've talked about K-Pit, riding the wave of automotive tech, playing the long game. Now let's shift gears a bit and talk about a company that's, well, it's kind of everywhere in India. Bajaj Finance.
Oh yeah, Bajaj Finance. They're like a household name at this point.
Right. I mean, they're into everything. Home loans, those little EMIs you get when you buy a new phone, we're everywhere.
And, that's actually one of their strengths. They're not overly reliant on any one sector. So if one area slows down, it doesn't tank their entire business.
That makes sense. They're diversified, spread the risk a bit, but they haven't been totally immune to the recent market downturn, have they?
True. They have faced some challenges. Interest rates are up, and the lending market is getting pretty crowded.
Okay, so more players vying for a piece of the pie. That makes sense. But I'm guessing there's a reason Shashank still sees potential in Bajaj Finance.
Exactly. Despite those challenges, their fundamentals are really solid. Like their net non-performing asset ratio, their NPA, is incredibly low.
Okay, hold on. We got to break that down. NPA, what is that?
It's basically a measure of how many of their loans are likely to go bad.
Okay, so the lower the NPA, the better.
Exactly. And Bajaj Finance's NPA is just 0.11. That's really, really good.
That is crazy low. So they're pretty good at managing risk, it seems.
Yeah, they know what they're doing. They're not just handing out loans to anyone and everyone.
All right, so low NPA, that's a good sign. What other metrics do we look at when we're talking about finance companies like this?
Well, there's the price-to-book ratio, or PB ratio. It's basically...
I'm going to stop you right there. I love a good analogy.
Okay, all right, so think of it like this. Imagine you're buying a used car. The PB ratio is kind of like comparing the price of the car to what all its parts are worth if you were to sell them separately.
Okay, I'm following.
So if the car's price is way higher than the value of its parts, it means people think it's worth more as a whole, right?
Yeah, because it runs well, it's reliable, all that.
Exactly. And with Bajaj Finance, their PB ratio is 5.9, while a company like HDFC, which is considered more established, is around 2 to 2.5.
So Bajaj is pricier, but does that mean there's still room for them to grow, to become even more valuable?
That's what the market seems to think. That higher PB ratio suggests investors believe Bajaj Finance has a lot more growth potential compared to HDFC.
Okay, so they're not a shiny new car, but they're not a clunker either.
Exactly. They still have miles to go. And here's something else to consider. Interest rate cuts are expected soon in India.
And lower interest rates usually mean?
More borrowing, more spending, more business for lenders like Bajaj Finance.
Sort of a domino effect.
Exactly.
Yeah.
But remember, this is just one piece of the puzzle. Investing is never that simple. There's always more to consider.
Always two sides to every coin, right?
Yeah.
And we're all about exploring all angles.
And speaking of exploring different angles,
Yeah.
this next one's interesting. It's more of a combo play.
Oh.
And it ties back to those growth triggers we were talking about.
Right. Finding those companies that are like in the right place at the right time.
Exactly. This one's tapping into two big trends, actually. Electric vehicles, of course.
Of course.
And then the whole push for clean energy.
Okay, now you're speaking my language. A 2-for-1 deal. I'm listening.
Yeah, so we're entering the Tata universe here.
Hmm.
Specifically, Tata Motors and Tata Power.
Tata. Man, that's a name you hear everywhere in India.
For good reason. They're a huge conglomerate.
But how do these two companies, Tata Motors and Tata Power, how do they fit into this whole growth trigger strategy?
Well, they're both making some really strategic moves within that EV megatrend.
Okay.
Like Tata Motors, they're actually splitting their business.
Oh, really?
Yeah, one part's going to be all EVs,
Wow.
and then the other part's going to be their traditional cars and trucks.
So as an investor, you could choose to just invest in the EV side of things.
Exactly. If you're really bullish on EVs, that's the way to go.
Okay, that's pretty cool. Gives you more kind of control over where your money's going.
Yeah, you're not stuck with the old gas guzzler side of the business if you don't want it.
I like it. And this ties back to, what we were talking about before, right? With rising incomes in India, more people wanting to buy cars?
Yeah, exactly. And EVs are becoming more and more accessible.
Makes sense. But what about Tata Power? How do they fit into all of this?
So they're not just about charging stations, although they do that too. They're going all in on green energy.
Okay, so we're talking solar, wind, all that.
All of it. They want to be major players in that transition to clean energy.
Mm-hmm. Which, again, huge growth trigger, right?
Absolutely. And they're already seeing some pretty nice profits in that segment. Like their EBITDA margins are around 30–35%.
That's a healthy margin.
Very healthy, yeah.
It's funny because that reminds me of, remember Nikhil Kama?
Yeah.
He basically said the energy transition is a gold mine.
Right. And he would know.
Exactly. Okay, so we've got Tata Motors going all in on EVs, Tata Power going all in on green energy.
Yep.
Why else should we be paying attention to these companies?
Well, Tata Power, they've got size on their side, which is huge. in this industry. They can secure funding for those massive green energy projects, the kind that smaller companies can only dream of.
Yeah, it takes a lot of capital to get those projects up and running.
It does, yeah. And then there's the whole vertical integration aspect of the Tata Group.
Vertical integration. Okay, break that down for me.
Sure. So basically it means companies within the group, they supply each other.
Oh, okay.
So they're not relying as much on outside suppliers, which can be expensive.
So they're keeping it all in the family, kind of?
Yeah, exactly. And it helps them keep costs down, which is good for profits in the long run.
Gotcha. Okay, so we've talked about the good, but every rose has its thorns, right? What about the risks?
Right. So with Tata Motors, you always have to consider the cyclical nature of the auto industry.
What do you mean by cyclical?
So it means it goes through ups and downs.
Oh, okay.
When the economy is doing well, people buy more cars. When it's not, they don't. And EVs, they're not immune to that.
Yeah, that makes sense. Even if everyone's going to be driving EVs eventually, we're not quite there yet.
Right. And then with Tata Power, competition is heating up.
Oh, how so?
You've got companies like Adani, they're investing heavily in green energy too.
Oh, yeah. Adani, they're everywhere these days.
They are. So that's something to watch. And of course, those big infrastructure projects, they require a lot of upfront investment, which can be risky.
Yeah, debt can be a scary thing.
It can be if those projects don't perform as expected.
Makes sense. Anything else we need to be aware of?
Well, there's always the regulatory landscape.
Mm-hmm.
Government policies can change, subsidies, tariffs, that kind of thing.
Right. That can definitely throw a wrench in the works.
It can, yeah. But that's why we do our research, right?
Yeah.
We try to anticipate these things as best we can.
Exactly. It's all about making informed decisions, weighing the risks and the rewards.
Couldn't have said it better myself.
So we've covered a lot of ground here. Cockpit, Bajaj Finance, this whole Tata combo.
Yeah, it's been quite a ride through the Indian market.
It has. And, it's easy to get caught up in the individual companies, the numbers, all that.
Right.
But stepping back, what's the common thread? What's Shawshank's big takeaway here?
I think it really boils down to those growth triggers.
Right. Those big trends that are like reshaping the world.
Exactly. He's finding companies that are, not just riding the wave, but they're the ones who built the surfboard.
They're ahead of the curve.
Exactly. And that's where the real opportunity lies.
And that long-term vision, right? Like we haven't really talked about like get rich quick schemes or anything.
No, not at all.
This is about like, planting seeds that'll grow over the next decade or more.
Exactly. It's about tuning out that short-term noise.
The daily ups and downs.
Yeah, all that stuff.
Yeah.
Because in the long run, it doesn't really matter.
It's about the bigger picture.
Exactly. And Shashank, he's got a very specific goal in mind. He wants to beat the Nifty index by like 3-4%.
The Nifty, that's India's benchmark index, right?
Yeah, so he's not just trying to keep pace with the market. He's trying to outperform it consistently.
It's ambitious.
It is, but it's also very measurable. It's not just, oh, I hope I make money. It's, I want to hit this specific target.
I like that. It's strategic.
Exactly.
So as we wrap up here, one last thought for our listeners. Given everything we've talked about, these growth triggers, these long-term trends, what other sectors in India do you think, might be worth a closer look?
Ooh, that's a good one.
Right. There's always more to explore.
Always.
And that's what makes this so exciting.
Exactly.
So to everyone listening, keep that curiosity going, do your research, and happy investing.
Couldn't have said it better myself.